Hello, listeners. Welcome to the Credit Compass, the podcast that helps you navigate the world of European credit. I am Gordon Kerr, European macro strategist and host. Welcome to today's episode, where we will delve into topics of recent interest impacting the economic landscape and the world of credit within the UK and Europe. Europe is facing a pivotal moment as it balances defense spending, economic competitiveness, and financial stability. These past several weeks and the weeks ahead will help to support the European economic direction. First, we will cover the impending increase in military spending and its support for equity market outperformance. Next, we will cover competitiveness and Mr. Draghi again. As always, a voice of common sense amongst the turmoil. Lastly, we will highlight the risk of rising leverage and something regulators are right to bring forward. Let's dig in. First of all, let's start with a priority for Europe, defense, and a hot topic this week. Over the weekend, leaders around the globe came together for the Munich Security Conference. A great deal of the focus was on the Russia-Ukraine conflict, as well as general comments around defense spending. The US does not want to be the world's peacekeeper anymore, or at least pay for it, and so Europe will need to increase defense spending. The UK, one of the largest European spenders as a percentage of GDP, committed to a pathway to increase their spending to 2.5%, even though they are already above the 2% level and one of the highest in Europe. After the Munich conference, European leaders met on Monday in Paris for emergency talks on Ukraine and defense again, the result of which was nothing particularly conclusive, with suggestions from Germany that the debate was focused on the wrong topic at the wrong time, while the UK committed to the potential for boots on the ground in a peacekeeping scenario. So how does this affect markets? Well, for starters, increased military spending will mean increased borrowing, a challenging time for countries that are trying to balance their budgets after loading up on debt in the pandemic period, particularly the UK, France, Belgium, Italy, and Spain. Even more traditionally fiscally conservative countries like Austria and the Netherlands have struggled to make meaningful progress since the pandemic with subdued growth levels. In terms of European fiscal rules, there is some subjectivity to the calculations that opens the door for things like increased defense spending to be ring-fenced outside of the traditional budgetary discipline. Germany's defense spending is already exempt from its constitutional debts break, allowing for off-budget military investments. If the EU were to implement this kind of a strategy, countries would find it easier to meet the defense spending target levels. But the extent to which markets would maintain confidence in the budgetary capabilities of an individual country remains uncertain. At a minimum, borrowing across all countries will likely increase, which is subsequently likely to increase yields in Europe across the curve and maintain the ongoing higher for longer narrative. 10-year yields across European sovereigns are up well over 10 basis points over the past week already. On the flip side, all this defense spending discussion sent European defense company shares up through the roof, helping drive the Euro Stoxx 50 index to new highs. The index reached a new high on the 13th of February 2025, closing at 5,464 points and surpassing levels last seen during the dot-com bubble in March 2000. A 25-year gap between peaks. Notably, U.S. indices have reached new peaks on numerous occasions over the past 25 years. In fact, the longest the S&P has been between peaks is only 8 years after the dot-com bubble bursting in 2000 as well. This recent surge in the equity market is attributed to strong performances by Spanish banks like Santander and BBVA, each experiencing roughly 30% gains on the year to date, as well as significant contributions from companies like Germany's SAP and ASML, a leading chip manufacturing company. Those gains are now further boosted by increased defense-connected industries in the past several days. Investors are increasingly attracted to the European market, perceiving it as undervalued compared to other regions. The index continues to reach new highs, topping 5,519 as of the end of day Monday, 17th of February, and was still ticking higher on Tuesday. It looks like Larry Fink was right in January, at least so far. Play the counter Davos trade. A negotiated peace could further support European market outlook, albeit heavily dependent upon the cost. Now, turning back to another ongoing topic of interest in Europe, at least on this podcast, competitiveness and growth. Europe is awakening to the realization that it needs to increase its competitiveness and fight back on the US administration's tariff threats and their potential impact. However, Mario Draghi, the former president of the European Central Bank, Prime Minister of Italy, and author of the recent lengthy report to the European Commission on the future competitiveness of Europe, recently wrote an article in the FT on the topic on Friday, the 14th of February. His comments highlight the main barriers for business in Europe remain within Europe, and the threats to growth are less external and more internal. An IMF report which he cites suggests that internal European barriers are equivalent to a tariff of 45% for manufacturing and 110% for services. Trade across EU countries is less than half of the level of trade across US states. And European domestic demand as a share of GDP is at the bottom of advanced economies. It has fallen to this low from middle of the pack levels prior to the global financial crisis. In the article, he calls for radical change. Let's hope Ursula and company are still listening. They have shown signs of it, but I am not sure it's happening fast enough. Lastly, we come to a topic that hopefully highlights a positive note for regulation, at least within the financial markets. Deutsche Bank is tightening lending conditions for purchasing significant risk transfers, aligning with regulatory concerns from both the European Central Bank and the International Monetary Fund about potential risks within the banking system due to leveraged transactions. The ECB is gathering data on banks' handling of leveraged SRT purchases, while US banks like Goldman Sachs and Bank of America are also increasing scrutiny, with some restricting investors from borrowing from other banks to fund SRT acquisitions. For those that don't know, SRT transactions are synthetic securitizations that offload bank risk to investors for a return without the actual sale of the assets. Banks actively use these transactions to help manage their balance sheet risk and, importantly, to meet regulatory capital requirements. This leverage offered to investors is rightly pointed out as a financial stability concern, as providing bank-held leverage goes against shifting bank risk from within the banking system. Further, it highlights that yields on this type of risk have recently fallen to levels that have pushed investors to take out leverage on these investments in order to meet their yield targets. Concurrently, the European Securities and Markets Authority has also raised alarms over rising leverage among European hedge funds, noting that some funds are managing up to a leverage multiple of 18. ESMA is particularly concerned about extreme borrowing and mortgage bond strategies and broader financial stability risks, including high U.S. stock valuations, geopolitical tensions, and potential investor complacency. All of this bull market leverage presents a risk to both overheating markets as well as to systemic problems in a downturn scenario. Both the SRT and equity leverage situations are positive examples where the regulator is keeping an eye on excessive leverage and raising red flags. In summary, rising defense budgets will likely strain public finances, but investors are betting positively on Europe's undervalued markets, sending stocks higher. Meanwhile, regulatory scrutiny on leveraged investments is tightening as authorities seek to curb systemic risks. With challenges on multiple fronts, from fiscal pressures to economic competitiveness, Europe's ability to adapt will help to shape its long-term growth and stability. Thank you for joining us in this podcast. Stay tuned for further updates as we continue to monitor these developments. As always, staying informed is key to navigating these complexities. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And if you have questions or topics you'd like us to cover in future, please drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the credit compass help guide your way.